Vanguard LifeStrategy funds. That's what we're going to talk about today in a couple different episodes of the Vanguard funds, the LifeStrategy funds, because there's a couple different ones you need to look at. And frankly, I get a question all the time. I had one fund to choose, what would it be? And I'm going to share with you right here, the Vanguard LifeStrategy funds. Well, it's literally that simple. Now I'll show you why. So welcome again to Heritage Wealth Planning YouTube channel. If you like what you see, subscribe, my friends, subscribe. We talk about all things financial planning, investment management, Roth IRAs. Don't forget my book. My book is free. Today's August 19th. The sucker is free on Amazon until tomorrow, August 20th. And then it's still free for Kindle Unlimited, $4.49 after that on Kindle, regular Kindle. And you can get the book, the paperback, for $5.99. So Amazon.com, Josh Scanlon, the book is free. And you definitely want to do that. All right, so let's dive right into this. Oh, if you do subscribe, don't forget to hit the notification bell to be notified for future content, because we do a lot of videos up here, my friends, and you want to be in the loop. All right, so what is a Vanguard LifeStrategy fund, and why should you care, and why should you own it? And look, I don't know if you should own it. I'm telling you, don't own it. Don't own it. No. Yeah, I'm not telling you to do this. I'm not saying that you, Mr. and Mrs. YouTube consumer, should do this. I don't know about you. I don't know about anything that's going on in your life. For me, this is the fund that I like, and it might not be appropriate for you. Now, there's a couple different Vanguard LifeStrategy funds, so we'll just go into each in different unique episodes. But so what happened? Let's just dive right into it. So Vanguard, first and foremost, they actually, hold on just a second. I'm going to give you my book, show you my book, Common Sense on Mutual Funds by John Bogle. Let me bring this up a little bit. This one right here, if you're interested in investing at all, this is the book you need to get. Common Sense by Mutual Funds on Mutual Funds by John Bogle. And look at that. Signed. Yeah, because when I worked at Vanguard, he came out to I think we're still in Camelback Road at that point, and this is 98. He came out and we got all these books. I think he gave it to us, actually. And then he signed it, and that was pretty cool. So get this book right here. Am I a Bogle head? Not necessarily, but I do. John Bogle is a man of all men, and I'm a big fan of him. And what he's done to save investors money is just he cannot be recognized enough. Talk about a Nobel Prize. I don't know why they don't have a Nobel Prize for that guy. But anyway, so I'm a big fan of Vanguard, as you can tell. At Vanguard Financial Planning, not necessarily, because they don't do financial planning. Schwab Financial Planning, they don't do financial planning. USAA Financial Planning, they don't do financial planning. And what's the other one? Vanguard, Schwab, Fidelity, I guess I say Fidelity. They don't. They do asset allocation and a couple different Monte Carlo analysis, and that's not financial planning. Nothing inherently wrong with that. But I do not like the idea of equating investments with financial planning. It's one of the banes of my existence, actually, because they are not one and the same. Financial planning is all encompassing. Investment management is one sliver of that. And frankly, investment management should be kind of heaped to the back end of various things, because once you see a fund like this, you don't need any more investment management. Just let Vanguard run it for you. All right. So what is a LifeStrategy fund? It's what's called it's a one fund meets all. An asset allocation fund. It's not a target date fund. Anyway, it's just a broad combination of a couple different funds within this one portfolio, one-stop shop. I'm drawing a blank of what they used to call these things. It's not a target date fund. But anyway, let me show you what this is. So Vanguard, you can right here, if 14 basis points is the expense ratio. You cannot beat the asset allocation fund. That's what it is, an asset allocation fund. 14%, 0.14 is a percentage of the cost to you as an investor. You're not going to beat that. Turnover is 6%, which means there's not a lot of active trading in there, which means from a capital gains perspective, you're not going to get much. Not at all. Now, it does have a 2% dividend yield, so that's roughly 30 basis points lower than the S&P 500. So every $100,000 you have in this puppy, you're going to get $2,000. You're not going to make a mint on the dividend yields in this guy. And frankly, you're not going to make a mint on any dividend yields in any fund today unless there's some significant risk there. I can't stress this enough. If you're buying an equity, because the stock has dividends, bonds have interest, those are not the same thing. All right. So I hear all the time, what's a dividend? And people are saying that for a bond, and that's not. Dividends are on stocks. Bonds have interest, or coupons, if you will, but the yield is what you get. A dividend has a yield, but it's a dividend payout. And you got to understand the difference. A dividend is 100% not guaranteed. It's no way. A dividend, they can stop the dividend. The company goes bankrupt. You're not getting the dividend. You are last in line if the company has to reconsolidate and they go bankrupt. If you own the stock and the dividend, you aren't getting paid. A bond, on the other hand, you actually have some say when they start selling off assets. Will you actually get some of that? I don't know, but that's what a bond is. A bond, as long as the company stays solvent, you will get your coupon, your yield is what it is. With a dividend, it's not like that. So you got to understand the difference. And then secondly, they're taxed so much differently too. So when you say dividend is a stock, when you say interest, that's a bond. Now you can say yield to go to both. And so here's a yield, 2.08, but it's a dividend yield. A bond yield is an interest yield. And again, taxed differently. There's more safety in a bond yield as opposed to a dividend yield. So you just got to understand the difference. Now, to some degree, some of the yield might be attributed to bond interest payments simply because it is an asset allocation fund where it has about 15 to 30% in bonds and 70 to 85% stocks. But anyway, so let's back to turnover. Turnover is just essentially the selling of the portfolio. If they had 100 stocks, they would sell 6 of them in any given year. All right, and a turnover of 6% is incredibly low, and it should be because it's an index fund. And that simply means there's not much in the way of capital gains that you could potentially pay if this is a non-IRA account. If it's an IRA account, it doesn't matter. But anyway, that's something to consider because high turnover can mean expenses are higher. Unfortunately, the shenanigans of the investment industry is we don't know what the cost of a high turnover, what the cost of tradings are, is not reflected in expenses. You just don't know. And so if you want to know for sure a way to keep your expenses down, the ones you can see and the ones that are hidden, and watch some of my other videos that talk about the hidden expenses on mutual funds, you want to keep your turnover as low as possible. All right, so if low turnover, low expenses, and they usually go hand in hand. A dividend yield of 2.08, and again, I'm kind of just going against what I just said, but essentially this will be mostly dividends because the bulk is in stocks, not bonds. All right, so let's then we have 70 to 85% in stocks and the rest in bonds. So let's see what else we got here, and we'll go into the growth here in just a second. I want to show you. Okay, here are the holdings. It's literally this simple. 48% the total stock index, 32% the total international index, 14% the total bond index, and 6% in the total bond international index. That is it, my friends. That's it. Four holdings of other Vanguard mutual funds, index funds. So basically roughly 50 in total stock, 30 in total international stock, 15 roughly in bonds, U.S. bonds, and 5 in international bonds. Literally, you aren't going to get more diversified. You're just not going to. You're covering every section of the market here for sure. And the nice thing about an asset allocation fund as opposed to a target date fund is these asset allocation funds do not get more conservative each and every year. So a target date fund, for instance, you buy a 2050 fund, it might be 70% stocks and 30% bonds. Today, in 5 years, it might be it will be 65% stocks, 35% bonds. In 10 years, it'll be 60-40 and whatnot. It gets progressively more conservative as it hits that target date. And that's not what we're trying to accomplish in asset allocation fund. We want to say we want to be well diversified, we want to rebalance, and we want to keep our expenses low. And the irony of it all is people say, oh, what's the Morningstar rating? And I've kind of come a little bit on full circle on that. Initially, I used to love the Morningstar ratings. That was back in the 90s when they were actually pretty poor, frankly. And then I did some research. I said, the Morningstar ratings are pretty poor. And Morningstar recognized that. And so they since changed. And over the last, since 2012, I think, 12, last 5 or 6 years, the Morningstar ratings are a pretty good indicator of a good fund to own. Doesn't mean it's going to be the best fund. It just means they're going to be lower fees, usually better performance, lower turnover, all the stuff that you want, and lower risk typically. All the stuff that you want when it comes to just an analysis of a mutual fund. The Morningstar ratings are a good place to start. Does that mean you just buy all 5-star ratings? No, but here's Vanguard with a 4-star, and that's good. Will Vanguard LifeStrategy ever be 5-star? Probably not. Why? Because the 5-star ratings can change. So what's 5-star today might not be 5-star tomorrow. I'd much rather get consistency between 4 and 5 stars. And the fact that it has low fees inherently means it'll be among the upper crust of the top performers for its category. It's just the fees right there alone. All the academics, my friends, all the academics, Morningstar, all the studies out there will say the one determination of asset or positive performance relative to the peers. There's one thing that you can determine consistent outperformance of a fund relative to its peers. One thing and one thing only, it's expenses. Literally, anyone who debates that is just wrong. Now, people say, well, you can have concentrated stocks, and concentrated stocks, they have all Amazon today or all Facebook or whatever. Yeah, that could outperform, but that's luck. And that's an incredible risk there, because if you have concentration in the FANG, Facebook, Apple, Netflix, and Google, for instance, you might kick butt and take names, but you also get hammered too. But there's one consistent measure of how to get outperformance relative to your peers and the vast majority of other funds out there, and it's low fees. No one's going to debate that. If someone debates that, they're either ignorant or they're lying to you. I don't know how else to put it. The numbers are in, and science, my friend, science has proven this. I always chuckle when people use science for investments, because there is no science. Not when you come to irrational behavior of human beings. That's not scientists. That's not scientific proof of anything. It just says historically that's been the one thing that has proven itself consistent, and I would extrapolate that, say going forward, that will be the one thing that continues to prove itself is low fees relative to your performance, relative to your peers or the vast majority of the markets. All right, so let's see. Let's just go back to growth of $10,000. I want to go historically. Let's go to maximum, because these guys have been around since 1994. And we start with $10,000 in 94, and it's now worth, I came into $65,000 today. All right, so we got hammered here like everything did. We got hammered. That's 2000, 2001, 2002, and then we had a little dead cat bounce, and that's 2003. A lot of people forget that dead cat bounce in the beginning of 2003. It seemed like we were out of the woods, and then kaboom, we took a hit again until March of 2003 is when we finally bottomed out. Then from 2003 all the way up to October 2007, we did fine, and then crack out like everything else, bump up, and you can see the rest. The rest is history. So what we see here is we have some significant declines because it is a heavy-oriented equity position for sure, but we've had some really decent returns for sure. Relative to its peers, this is us, a typical allocation of 70 to 85% equity. We smoked it, and then the Morningstar moderate target risk total return, we've smoked the benchmark there. And what comprises of the benchmark, I don't know. But so you can say at the end of the day, you can compare. I wonder if it even allows us to compare. I don't know if it does. But you can compare this to anything you want. Say at the end of the day, the LifeStrategy Fund has a 25-year track record. 10,000 has grown into 65,000. It has some down years. There's no getting around that. But the facts are, every fund, there's no fund that avoided this or this. This is 2016. That's 2011 right there. That's right. That's a Dubai debt crisis right there. Look at that. I remember people freaking out. That's in July of 2011. That's the beginning of 2016. No one escaped any of that stuff. And so at the end of the day, this fund has done just fine. It's done very well. 10,000 is now worth 65,000. Tough to beat. All right. So let's see. 10 years it's averaged, what's that? 7.07 over 10 years. That means it's doubling. If you get 7.2%, you're doubling your money every 10 years. You get 10%, you're doubling your money every 7.2 years. So if you can double your money over 10 years, I'll take that, absolutely. And part of those years includes this right here. So that's not too shabby. What has it done against its peers in the last 5 years? Is in the 26th percentile. So basically it's beaten 74% of its peers. Over the last 10 years, it's beaten a little bit more than half of its peers. Over 3, it's beaten 70% of its peers. I mean, again, will it continue to do? I don't know. People say, well, it's only beaten 52% of its peers. I want to get the funds that have beaten more than that. Yeah, good luck finding it. I mean, I'm telling you, go. Good luck finding that for sure. I mean, there are funds out there. The question is, will it be consistent? The answer is no. But yeah, by all means, search. Frankly, if I can get 7% over 10 years each year, roughly, on the aggregate, that means I've doubled my money 10 years. I'm very comfortable with that, and you should be too. All right, so here, that's the breakdown again. Literally that simple. Stocks, domestic stocks, domestic or international stocks, domestic bonds, international bonds. You just keep it simple. It's literally that simple. I don't even know what else I need. Oh, let's take a look at the tax efficiency here. So if you're having this in an IRA or a Roth or a 401k, tax efficiency is not of a concern of yours. If you have this outside of a Roth or a traditional IRA or 401k, tax efficiency is going to be a big concern. And the funny thing is, all those returns I just looked at are all gross of taxation, all right? The gross of taxation, and they are net of fees. So if you're looking at something to compare this fund to, you want to look at it taxation. And so let's take a look here. So net of taxes, all right? So since inception, this guy in 1994 has averaged 8.19, but net of taxes is 7.27. So we've lost 80 basis points. That's about 10% of the portfolio we've lost to taxation, which frankly isn't that bad. Over the last 15 years, we've lost 70 basis points to taxation, which means after taxes, remember we talked about that before, is in the top 48% before taxes. After taxes over the last 15 years, it's in the top 16%. When you factor in taxes, this consistently ranks in the top, not the quadrant, the quintile. Look at that. 3 years, 20%, 5 years, 14%, 10 years, 20%, 15, 16%, 1 year, 34%, but I frankly could care less about 1 year, 5, 10, and 15. So if we're 5, 10, 15, we can throw 3 in there just to be fun. After taxes, that's all that matters, what comes back to you. It doesn't matter what comes back to you plus Uncle Sam, just matters what ends up in your purse or your pocket. And after taxes, this consistently ranks in the top quintile. You can't beat that. Now, here's the thing a lot of people are not understanding. You got a 40% potential capital gain exposure. And that's not just this fund, it's all of these funds out there. And the reason is because we haven't had hardly any down market except for the years of Dubai debt crisis in 2010, July 15th to August 31st of 2011, and then the beginning of 2016. We haven't had any down market whatsoever. So there are a lot of these funds are holding a lot of upside that they haven't sold, and that could be problematic for future taxes for sure. 40% of the portfolio is unrealized gains. All right. So you just got to keep that in mind, because every year they pay distributions out for capital gain distributions, and those distributions are going to come back to you as part of this negative return right here. 7.75 to 7.05. That means you lost 70 basis points, 0.75% of the overall return to taxes. And that's not going anywhere anytime soon unless something happens in the market where we take a significant drop. The nice thing with Vanguard, because they're not doing a lot of trading, a lot of this will never be realized. So unrealized gains are what these are, where they just sit there and they sit there and they sit there. Realized gains are when they sell stuff, but they don't do a lot of selling, so they're not going to realize these gains. They'll stay unrealized for a long time. Now, some of that, they will be sold. I mean, things drop out of the S&P 500. Things get added to the total stock index. They will sell some stuff, and that's where the 6% turnover comes in, that they do have to sell 6 positions out of every 100 they have per year. That's just incredibly low. So a lot of this for the Vanguard funds won't be realized, which means there won't be a big tax burden to you, but there could be some for sure, and we can see it. I mean, look at that. 7.27, 6.49, 8.82, 7.81. 9.75. So basically, we're going to lose 0.75% each year to taxes for sure. And that's just something you got to contend with. You're not going to see this going away anytime soon unless they have a lot of selling where they got to pay you a significant capital gain distribution, which is not what we want, or we take a big drop in the market, and then that will eliminate some of the unrealized gains because the stock prices fall. So we don't want to see that much. And that's it. I mean, that's what I love about this. I don't care much about the stewardship thing. We talked about the expenses. We talked about the portfolio. I wonder if they give us a breakdown year over year. If not, we'll pause it, go to the Yahoo thing, because Yahoo does break it down year over year. Let's see what these guys do. I like the Morningstar because they have that tax stuff, my friends. I'm a big fan of that tax stuff. So Morningstar did do a study, which I thought was pretty interesting, where they say investor returns. And I've talked about this a couple of times. A lot of these people out there in financial planning will use their what's called behavioral coaching as a way to encourage you to invest with them. They say, I'm not here to pick the best stock or bond. Thankfully, I'm here to make sure you don't make a mistake. And I actually kind of get that. I mean, we don't want you to sell in October of 2002. We want you to buy in October 2002. We don't want you to sell in March of 2009, and so on and so on. And that's the mistake people make. That I sell at the bottom, I buy at the high. We don't want that to happen. I frankly don't see that happening as often as what some of the investment recommendation folks say that, if it weren't for me, you're going to do something stupid. I just don't see it that often. I'm sure some people do, but the vast majority of people that I've worked with, they don't make stupid mistakes. They just buy and hold and sit there because they just don't want to mess with it. And if that's you, then we don't need to worry about the behavior coaching that some of these advisors talk about. So what we'll see, I don't think they do 13, 14, 15. So I'm going to go down to I'm going to pause this for a second because I want to bring up Yahoo because I think the Yahoo is actually pretty good. Let me get the ticker, VASGX. I'm going to bring up the Yahoo. I'll show you the year over year. I'll pause for just a second. All right, my friends, so we're back. So I brought up Yahoo, and what I like about Yahoo, this finance.yahoo.com, is they give you the year over year in terms of annual total return history. And I'm a huge fan of this because it just shows you. And so we'll dive into that here in just a second. So let's take a look. What are they? They're using this. So they're comparing the category, and I'm not sure what the category is they're using that they're comparing this to. Yeah, it's weird. I'm missing it. All right. So I don't see the category. All right. So we'll have to come back and see if we can't find the cat. I wonder if it's down here. No. All right. So a couple things. This is what we want to look at. So here's 2001 and 2. So the aggressive life strategy fund at Vanguard was down 5.44, 8.86, and 15.84 consecutively. And then in 2008, it was down 34.39. All right, so to get those returns, basically, what do we average? I don't even think it says on Vanguard. I don't get why it doesn't say since inception like Morningstar did, but I don't think it does down here either. No, it's too bad. All right, so let's see if it was showing us here. Yeah, they only go 5 years, and I just don't care about 5 years. I mean, it kind of, but I care more about 10 and 15. But there you go. Still, ranking category by total return for 5 years is 21%. Again, that's before taxes. Not sure what the category is they're using. So let's just click on this guy real quick. So that's what you have to contend with. To get that kind of rates of return of 10,000 today in 1994, growing to 65,000 today, you had to deal with 5.5. 8.8, 15.84, 2001 and 2, and then 34.5 roughly in 2008. Could you do it? I mean, I don't know. I'm just writing this down so we can revisit this. I mean, that's a tough one, my friends. I mean, could you do it? Sounds easy now. Didn't sound so easy before. I'm telling you, I remember what it was like in March of 2009. It was freaking scary, man. We thought everything was coming apart. And rank and risk, sustainability. I love how they do all these sustainability things. I see this thing about the industry. It's just so cliched. I don't see what category they're using here. Oh, category allocation 70-85% equity. Well, okay. All right, so that's the Vanguard LifeStrategy growth. That's one of my. If I had one growth aggressive fund to choose, it would be this. Now, frankly, does that mean you should buy it? No, don't buy it. I'm just telling you. I am not telling you to buy it. I would say for me, old Josh, if I had one fund to buy, would it be this? I'm saying to you, don't do it. I don't want anyone to say, Josh Scanlon, that crazy guy, said to buy this. Nope, not saying it, not saying it, not saying it. I'm saying for me, if I had one fund to choose that was more aggressive, it would be this. And so why do I say this so explicitly? Because the regulators and all these out there saying, you said it recommended to buy it. No, I'm not. Absolutely not. I'm saying you should look into it and decide for yourself because I've been in this a long time. I know how this stuff works, and it's actually sad that you can't just even talk investments without someone saying, you're making a recommendation. You're like, no, I'm not. I'm absolutely not. I'm just saying for me, this is what I look at. You should look at it. Should you buy it? No, you should not. You should not buy it. All right, so I hope you like this Vanguard LifeStrategy fund. It's something you should look at. Look at similar funds by all means, but we'll talk about the Vanguard moderate one next. And so don't forget to subscribe down below. Go to the blog at heritagewealthplanning.com. Thumbs up and comments. Thumbs up and comments. Shh. The thumbs up and comments always tell the YouTube algorithm, our overseers in the AI world, the artificial intelligence, that people like this stuff. And that tells people, the algorithm, to say, hey, we should put this content out for other people to see. So if you give me a thumbs up, you're not only going to help me get the channel to grow, you will, but if you think this video is worth other people seeing, a thumbs up helps, because that tells our overlords in the artificial intelligence that other people should see it as well. So thumbs up and comments. Appreciate it, guys. We'll see you next time.